So crypto is really interesting. Same with technology stocks, is they are in an exponential logarithmic uptrend because they are network adoption models. So in technology stocks, we've got the relentless, ongoing, ridiculous pace of rise of AI, robotics, EV, space, Internet of Things, 5G, 6G. Genetic sciences, all of these things are all coming together at the same time. It's the fastest pace of change humanity will ever go through. It's hard enough for us to deal with on a societal level, but that's not stopping. Part of that is blockchain technology, digital assets. They're in the same exponential trend, but maybe even faster, because crypto with 300 million users is the fastest adoption of any technology the world has ever seen, twice the speed of the internet. So what you're thinking, so if you can visualize, is you've basically got this massive uptrend that is exponential in nature, but when you put it on a log trend, it's quite nice and smooth. But you've got these big swings. Those big swings are driven by the macro. So what we've done is we're at the bottom of the macro cycle. But don't forget, every day there's new people building in the ecosystem, there's new adoption. People like Ticketmaster have issued 10 million NFTs without anybody realizing. The scale of what is happening is ridiculous. So the beach ball is held underwater the moment quantitative tightening or rate rises stop. And so that is why I am incredibly interested at this moment in time, right here, right now, because I think we're getting very close to the point where growth implodes. We've already seen 2 quarters of negative GDP in the US. We've already seen housing rollover. We've already seen supply chain issues ease. We've already seen most commodity prices fall 50%. We've already seen the dollar explode higher. The dollar's hugely deflationary because the largest exporting nations in the world, Japan, Germany, China, have all seen their currencies decline massively. So they're now selling finished goods at much lower prices. So the macro turn is very close. When we look at on-chain analytics, we start to see things that only ever happen in these massive bear market sell-offs. The 2014 sell-off, the 2017 sell-off, stuff like that. We also are at the bottom of the logarithmic trend channel, 2 standard deviations oversold. That's usually a good one. We're at the 5-year exponential moving average. That level has proven to be about the best risk reward you can ever find. Things like, if we use technical analysis, things like the RSI, as oversold as they have been at the bottom of every other cycle. So we've got this massively oversold crypto market at the time where the macro narrative is at peak. And any rate of change means that the risk reward of digital assets from here, normally when you get to this confluence of events, the risk reward is somewhere between 20 to 50x. Now, it depends where you are on the risk curve, which is going to answer the second part of your question, Mark. Bitcoin is the least attractive of the major assets because it has more stability, further network effects. Therefore, as you get further network effects, your growth comes down over time. So, where would Bitcoin go in the next cycle? Who knows? But let's say 200,000. But then we look at the network adoption effects in Ethereum. How many people are building on the Ethereum network? The ability to now get yield on the network. What's that going to mean for DeFi? Who's going to build DeFi on top of this new kind of benchmark yield rate that's coming out of this? All of the people who are building NFTs, all of the stuff going on. Okay, that's mainly happening on Ethereum right now. Great. Ethereum's slow and Ethereum's expensive. So the market will seek the path of which they can get more stuff done at a faster pace, and they will make trade-offs. Trade-off is decentralization versus speed and cost. So when you move out the speed and cost curve, you basically arrive at Solana, Avalanche, Algorand, a whole bunch of these layer ones. So, then you start splitting out those assets and say, okay, how do I differentiate? And it's quite difficult, unless you're a technologist. But basically how I perceive it is Solana seems like it wants to go for the masses and create these kind of onboarding experiences, front ends. They've got a mobile phone. They've got amazing NFT marketplace. They seem like they want to get involved in the public. Then you've got Avalanche, and that seems to want to be more technical. We've got these subnets. You can do your things. It's a bit more technical, and we can probably financialize real assets on it. That seems to be their narrative. Algorand somewhere like the financial marketplace, stuff like this. So the market probably, Bitcoin underperforms, Ethereum next, whichever one of these, and I don't know which ones, will do pretty well. And then there'll be new tokens of which we don't really know yet coming in that solve more problems, where you'll see the 1000x upsides that we've seen in past cycles. And then there's a bunch of shit that goes to zero. Well, it doesn't go to zero. It just, goes up and down with the speculative hype flow. So that's kind of how I'm seeing that. So in the asset management side of what I'm doing, we're going further out the risk curve now, finding people who are taking those bets, because those bets are going to be more important drivers of returns than ETH or Bitcoin over time. When have you ever found an institution who buys at the low? What we need is FOMO. Most of them, I've spoken to a lot of them. The reason they haven't allocated a lot of them have done VC first, because it's easy to get through investment committee. It's just like a technology investment. But then they've struggled with product. So, they can't invest in individual hedge funds. It's just too hard for them, because, they can't do due diligence on custody risk, DeFi risk, stuff like that. They just don't know how to do it yet. It's too new for them. So, fund-of-fund products like you guys have built and I've built, those are going to be the kind of products that they need, much like it was for family offices. I know that hedge funds is the next part of the space that they will come into, because I've seen this rule book, this playbook many times before. And you need that thing that makes them not feel like idiots, which is they need the price to go up. And I know that's stupid, but it is what it is, right? That's why family offices and high net worth investors have been much better at capturing the alpha in this space than institutions, because they don't get fired. They don't get fired for doing the wrong thing. And regulation at the margin, family offices and high net worth tend to be more risk-taking, because they're in control of their own capital. So the fiduciary duty they owe to themselves, so they will say, I understand it's not fully regulated yet, but I will take the risk. And they've been compensated for that risk by doing so. Institutions can't do that because their fiduciary duty to these millions of people and all of that kind of stuff. Regulatory clarity helps them. And so people look at this regulation space and really, we need it if you want adoption. This libertarian ideal of nobody's going to regulate our money, this is our new digital money, you can't do it, is a fantasy, because we all live in a physical jurisdiction, and the physical jurisdiction wants its share of taxes, because you get benefit from being a societal member. Now, if you move elsewhere, I live in the Cayman Islands, so I don't pay direct taxes. Sure, we have taxes on import duties and other stuff. They always find a way to get money from you. But that's the thing, is if you live in a country you can't avoid taxes, they want to make sure they get their fair share. Because don't forget, the world is pretty much bankrupt right now, and they need to make sure that they collect as much taxes as possible. So I think regulation is a good thing. I think it's coming. I think the space where the battle is going to get drawn up really is DeFi, because DeFi needs KYC, AML, and it can't by its very structure. So we're seeing people spinning up new institutional KYC, AML versions of DeFi protocols, which I think is useful. So that means we'll end up with a bifurcated world, like, some of your funds, and in fact, half the world's funds are in the Cayman Islands. Why is that? Nobody's avoiding taxes. You're doing it because it's a tax neutral jurisdiction that allows a fair and clear regulatory framework for any legal dispute, but it also allows international investors to pay their own taxes in their home country. It makes it easy. So will we have offshore DeFi and onshore DeFi? For sure, because you can't impose US DeFi restrictions on an investor in South Africa. What is magic about this space is we all get to own a part of the network. So whatever they do on the space is going to benefit us if we own parts of the network. That's by owning the tokens. We've seen the European Investment Bank, the EIB, issue bonds on Ethereum. So my hypothesis has been most traditional assets are about $200 to $300 trillion in market cap. The best thing is own the bloody token. You can say, well, we don't want the institutions coming in. Well, you might as well profit from it. Own the token. So I own the ecosystem, invest in the hedge funds, do whatever, capture the alpha and the beta of the space.